Welcome to another pop-up event with the Coinbase Institute. I'm your host, Hermine Wong, director of the Coinbase Institute. Our goal is to host these pop-up events in real time as crypto policy events unfold and get quick takes from experts to unpack these issues. For this event, I'm incredibly excited to introduce our guest to chat with us about stablecoins policy. 2 weeks ago, the Coinbase Institute published a white paper on stablecoins. So now you may be asking yourself, what is a stablecoin? Is it different from crypto? Do policymakers think about them differently, and should they? How are they already regulated? To dive into all these questions, we've invited 3 amazing experts to chat through these issues with me. I'm excited to introduce first Christian Catalini, co-founder and chief strategic officer at Lightspark, formerly co-creator of Libra DM at Facebook, now Meta, and founder of the MIT Crypto Economics Lab. Bao Nguyen, a partner at Skadden Arps and formerly the Office of the Comptroller of Currency and Federal Reserve Board. And finally, Scott Bogus, VP of Global Regulatory Policy and formerly at the SEC and UT Austin and University of Michigan Law School. Welcome to all of you, and thank you again for joining me today. For the audience, I just want to let you know that you can send in your questions, drop them into the YouTube chat feature at any point, and we will try to get to them as we continue on this program. But let me start off right now with Christian. Christian, if I can ask you, stablecoins are rapidly gaining popularity. The market cap for stablecoins globally is around $145 billion, 13 times what it was in May 2020. Can you help us understand a little bit about the appeal of stablecoins? What are the benefits? What problems are they trying to solve?
I would say there's at least 3 main reasons. The first one is that most crypto assets are extremely volatile. And so crypto has been looking for years now for reliable stores of value that do not exhibit that kind of volatility. Whether you're trading or investing across different exchanges, moving in and out of things like Bitcoin or Ether, you need to be able to retreat to something that tracks more the value of more traditional assets, say like the US dollars. And so the original use case for stablecoins was very much crypto-centric as kind of that stable unit of account that people could rely on when they're performing everything else in crypto. Over time, of course, as DeFi or decentralized finance developed further, it became even more clear that if you want any form of financial contract, you need to be able to refer them and denominate them in something that tracks a stable asset. Imagine taking a mortgage in Bitcoin on your home. Well, you could get either extremely lucky if the price of Bitcoin collapses, because now you owe a lot less to whoever lent you that loan, or you could be extremely unlucky if Bitcoin appreciates. Now you owe maybe 10 times as much. And so stablecoins are really critical for any form of DeFi contract because you want to be able to denominate things in dollars, and dollars being the reserve currency is kind of the denomination currency for all of DeFi today. But that's just the first reason. I think the second and really important reason is that as crypto develops and becomes much more mainstream, that bridge between more traditional financial services and systems, banking, financial institutions, and crypto is typically performed by a stablecoin. Of course, people can rely on more traditional on and off ramps, go through kind of more traditional banking transactions or payments, but stablecoins are faster, more efficient. And so often at the interface between the old world or traditional finance and crypto, you have stablecoins. They're kind of the connective juncture. It's also the reason why I think they've been under so much scrutiny and so much attention, because they're the first part of the traditional financial system to be exposed to some of these crypto primitives. But last, and I would say more important in the long run, I think people are excited about stablecoins as a means to really reform and revolutionize our payment system. Payment systems domestically and also globally are often fragmented, inefficient, slow. There's no such thing as real-time settlement in many countries. And stablecoins provide all of that with interoperability. Interoperability being probably the most important economic concept related to stablecoins. So the idea that doesn't matter if I'm using wallet from company A or company B, or paying a merchant that's supported by a payment service provider A or B, everybody can pay each other without friction. That's not the world we live in today. We're in a world where each digital wallet is a little bit like a wallet garden, and crypto is there to really break those wallet gardens and interconnect all these systems that don't talk to each other. Imagine, trying to pay your friend that is using a different digital wallet today. Typically, you cannot do it. With stablecoin rails and crypto in general, all of that becomes possible. And that's always been historically a really strong force for competition. Think about the early days of the internet. A big part of the upside of the commercial internet was all these services that suddenly were interoperable. Think about TCP/IP, so moving data, email, SMTP, EMAP, and all these internet protocols that enable different types of organizations not only to talk to each other and interoperate and be compatible, but also to compete. And that competition has been a driving force for innovation for decades, over the last years.
Amazing. So Christian, if I can reframe some of what you said, tell me if I'm getting this right then. One of the great things about stablecoins utility is this idea that it can tie us very closely to what we're already familiar with, and this what we call fiat currency. So the US dollar, the euro, and I can use it to help take it out of this crypto economy that I'm hearing about. Is that right?
Well, to some extent, the two economies are connected, and people, especially in the United States, of course, tend to think in dollars. All of our purchases, all our expenses, our salaries are denominated in dollars. And so even if we're active in crypto, it's really important to be able to refer to our main unit of account. And
then when you talk about digital wallets being in walled gardens, and it's hard for us to operate with that, tell me, right now, if I am in Colombia, for example, is that something how is it that I am in a difficult digital wallet space?
Yeah, so imagine something as simple as global remittances, right? So the internet has been around for decades, but moving money is still extremely expensive. On average, it's more than 6% that is paid on any cross-border flow. And part of that is because we have a patchwork of different systems that don't really talk to each other. So if you're sending money, you're typically going maybe from your domestic rails to some international system, and eventually to some other type of domestic rail on the other end. There's a lot of intermediaries in the picture. Everyone takes a cut. And at the end, whoever is trying to receive those funds, that value, is receiving a lot less. Now, crypto, I think, changes completely that picture by removing a lot of the intermediation that's necessary in supporting that money flow. On stablecoin rails, for example, as long as, say, a user is in the United States on any crypto wallet, and the receiver is also on a different crypto wallet on the other end, they can send money peer-to-peer instantaneously with essentially almost no fees in most cases.
Okay, thank you, Christian. So, Bao, if I can turn to you. Right now, when it comes to stablecoins, Christian just laid out for us why people might use them, what's the attractive benefits to using them, and how we can use them as a digital native product, an internet-based product. When it comes to regulations, there's no single regulator, certainly in the United States, who's looking discreetly at stablecoins. Can you tell us historically why is that, and how are regulators thinking about it now, and how should they be thinking about it?
On the historical side, I would say the reason for that is really a result of the way our financial regulatory architecture has been set up in the United States. It's fairly fragmented, and I think we've accepted the fragmentation, and it's focused in the first instance on legal entity, but whether the legal entity is captured sort of turns on its activity. So as a result, an activity could be covered by multiple regulators. You think of something like mortgage lending as an example. A mortgage loan is regulated by a state, the state regulator. If it's done by a bank, it's also subject to potentially a federal regulator. The Federal Housing Fund, FHFA. If you sell it to one of the government enterprises, someone else will come into the fold. So it's fairly typical in our US financial architecture for a single activity to be touched by multiple regulators. That is not unusual. And I think stablecoin fits within that paradigm and that framework. So it's not unusual that we don't have a single regulator. And my view is that the best we can hope for is more coherent coordination among the regulators. But I think we would be foolhardy to think that at some point down the road, we'll get a single regulator for stablecoins because, as Christian pointed out, it has a variety of uses. And depending on how you use it, it could go into different jurisdiction of different regulators. So to the extent that you think of a stablecoin as a technological tool that really is about nothing more than the technology, right? You're probably going to have state regulation sort of apply just on those sorts of questions. To the extent that you think of stablecoin as a mechanism to facilitate payments, you're going to have regulation at the state in terms of money transmission. You're going to have licensing requirements at the state, but you're going to also have federal regulators like the Federal Reserve and their sort of view about how the payment system ought to work. So a lot of it will depend on how we think about the use cases for stablecoin sort of moving forward. And I think because there are a variety of use cases, likelihood is variety of regulation, a variety of regulatory framework will sort of persist. And what we can hope for is more thorough thinking so that there's better coordination. You know, I'll go back to my mortgage example. Today, we have a fairly robust, coherent mortgage market. Lots of regulators touch the issue, but it's not sort of confusing or sort of contradictory. There's sort of streamlined processes for how the regulators interact and you know, the piece of the pie that they get to touch, so to speak.
Okay, thanks, Bao. That's helpful to know a little bit about this history of what you call the regulatory patchwork system for some of these financial products. Scott, the Coinbase Institute recently released a white paper on stablecoins. You were very much involved in that white paper. Can you tell us a little bit about what was in that paper that made it different from the existing literature on stablecoins already?
Well, that's a good question, Hermine. There are a lot of papers out there about stable coins, but there was one aspect that we didn't think was sufficiently covered. And it really proceeded from first the PWG report last November on their view of stable coins from an FSOC or systemic risk perspective. And then that was followed by two international committees joining forces, the CPMI and IOSCO, international bodies, standard setters, who issued a consultation on principles of financial market infrastructure, again, addressing the systemic risk concerns of something called a stablecoin arrangement. But in all these discussions, there wasn't really a definition of stablecoin arrangement. At Coinbase, we're largely asset agnostic. We promote different types of cryptocurrencies if they're safe and efficient. There are different types of stablecoin arrangements that we think are viable, but there was a one-size-all treatment of stablecoins in a lot of these discussions, and we thought it was relevant to parse it out. And there's a lot of theoretical risks with stablecoins that we thought were overstated, and so we thought, let's just create a fair and balanced assessment of what stablecoins are, so that policymakers and others can talk about it in a very balanced way. There was one drawback in terms of our initial draft of the paper, in that we were pushing back on theoretical concerns, and we were almost done with it, and something happened in May called Terra USD, the collapse and the big unwind. And so it was a perfect opportunity, it was a gift to us to be able to look at some of the empirical aspects of stablecoins and highlight some of the differences between fiat-backed or custodial stablecoins from purely algorithmic stablecoins like Terra USD versus stablecoins like DAI that are backed by exogenous crypto assets, but otherwise run by a smart contract or algorithmic. And it showed a lot of really interesting aspects of the market, in that we now had an unwind, a deleveraging, all the TVL, the total value locked and smart contracts come out. And we saw it happen in real time. And it was really important from a systemic risk point of view, is that the whole world got to watch it in real time. It wasn't a bunch of senior bank regulators in a back room looking at AIG balance sheet and wondering what should happen, should they be bailed out. It was a real-time unwinding of a bunch of leverage in a system, and we got to see it. And we also got to see what happened to the various stable coins, like what happened to an algorithmic stable coins exogenously backed. It actually performed extremely well. We saw the custodial stable coins like USDC do extremely well. And so we added that into the stablecoin white paper, and we very lightly polished policy considerations and said regulators need to think about not just systemic risk, they need to think about monetary policy, the dollarization of economies or the eurozation of economies and emerging economies. The issue of the concentration of economic power, it often is the elephant in the room. Libra DM had some issues on that front. And is that the reason why regulators are concerned? And are they using systemic risk as kind of a front for thinking about issues of concentration of economic power? And so that was the idea of the stablecoin white paper, is to unpack a lot of those issues.
So Scott, you raised two really important points that I think is helpful to unpack for our audience here. One is there's a little bit of alphabet soup when it comes to all of these regulatory bodies that we're talking about. PWG, FSOC, CPMII, OSCO. This is different from a lot of the space we hear about with crypto normally. We often hear when it comes to crypto something more about SEC, CFTC. So now we're talking about FSOC, Financial Stability Oversight Council here in the United States, PWG, President's Working Group, CPMI, OSCO, which you mentioned as being international bodies. Why are those the ones that you're talking about when it comes to stable coins? Opening up the floor to everyone on this one.
I can start with the response. Oh, go ahead, Christian.
Oh, okay. I mean, to some extent, I feel like I have to start because the involvement of some of those acronyms was really triggered by the Libra and DM project. There were concerns around the ability of our project like DM and Libra to massively scale. And that's the only reason why FSOC, was involved. And to some extent, the Presidential Working Group, which we've interacted extensively during the design of DM, came up with a report that very much absorbed all of the core elements that we were proposing with the DM design. I think at least in the United States, and of course different countries are going to have very idiosyncratic characteristics on this, there are natural homes for stablecoin regulation because banks are involved or are going to be more and more involved, or bank-like institutions will be involved in issuing these tokens. The Fed, of course, will have a major role to play in setting the right guidelines, in setting the right standards for reserve management, or an entity like the OCC could potentially develop a customized charter for entities that are issuing stablecoins. So at least at the federal level, there's two very natural homes for stablecoins, and that's not the SEC. I mean, the moment a stablecoin is classified as a security, it becomes kind of useless, and it cannot be used as a medium of exchange effectively. I mean, how many of you have purchased anything with a money market fund in recent times? At the state level, we also have really good examples of jurisdictions like New York, with New York DFS, that have developed stablecoin frameworks that are not only safe and sound, but have also evolved with the space. That said, again, I think everything we've seen, including the recent meltdown, which could have been totally avoided, of Terra Luna, reflects the fact that regulators were maybe too concerned about the DM design, a little bit less about some of these algorithmic stablecoins that were actually scaling massively across borders, and that's the result of what we've seen recently with designs that do not have solid economic fundamentals and can come crashing down in the dead spiral at any moment in time.
Yeah, and for the record, Christian predicted the Terra USD collapse in an academic article that we cited in our stablecoin white paper. Hermine, to your question about CPMI and OSCO, their relevance, International Organization of Securities Commissions and the Committee on Payment Market Infrastructure, the big concern is for Coinbase and other market participants is that each national jurisdiction will adopt their own rules and they don't fit together. These international committees are important because it gets the national authorities together in the same room to talk about the issues and promulgate standards that each authority can adopt that are generally similar. There might be some differences, but they're the tip of the spear in many cases in terms of what those adoptions may look like. The SEC is certainly moving ahead right now with stablecoin legislation, or trying to move forward with stablecoin legislation, but a lot of that is borrowing from principles, I believe, that the standard setters internationally are talking about. All these discussions are happening across borders in each jurisdiction, thinking about what of those principles should be adopted in their jurisdiction.
If I could add to that, I would say, one of the reasons you're talking about FSOC and the Fed in this context versus the SEC is I think you're fundamentally thinking about stablecoin in a different set of use cases here, as a payment mechanism, as a substitute for value versus as a investment contract. right? And so it creates, therefore, these questions around, as Scott pointed out, monetary policy. So if you have a broadly accepted, widely used substitute for the dollar, what implication does that have for the Federal Reserve in its exercise of monetary policy? That's why they sort of want to get involved. If you have something that is hugely scalable, and you know, over the course of 6 months, 12 months, 18 months, could sort of have billions of users, you immediately have questions around concentration and systemic risk, and therefore the FSOC sort of gets involved. So I think that's a big part of why these acronyms come into play versus the SEC, which is, I think, ill-equipped to sort of deal with questions around prudential regulations such as systemic risk. They don't do anything on monetary policy. They are really focused on disclosure of an investment contract, more so than anything else. And that's, in the grand scheme of things, fairly parochial relative to stability and monetary policy.
All right, thanks all for that. Now, the other point that Scott brought up earlier was, and Christian, you also talked about this, is the idea of a fiat-backed, crypto-backed, algorithmic stablecoins. These are all different implementations of stablecoins. Can, Scott, if you can like take first stab at kind of unpacking what is the difference between those, and then maybe giving a little context on how we think about that in this current state. You talked about the deleveraging that recently happened. Tell us how that was different than if it had been pure, like we were at a fiat-backed system only.
Well, I feel like if I go first, I'm going to steal all of Christian's great work because most of what I learned came from his work. So if you don't mind, I'm going to defer to Christian and then back cleanup.
Okay. So I think at a high level, and Scott is way too nice. You know, there's, I would say, three major categories, right? So we have the fiat-backed stablecoins. Think about USDC, Gemini dollar, Pax dollar, and of course, less transparent and audited things like Tether, that are trying to maintain that peg by putting in the reserve assets that are supposed to be cash-like. And the gold standard for that is, you know, U.S. Treasuries of 3 months or less, and cash at the Fed. And unfortunately, that's a design that we don't see in the market fully yet. It's, you know, the safest design because it's one that even in stress market conditions always guarantees that on-demand redemption can be fulfilled, and if even people run on the reserve, you're able to give everybody par. Because typically, you know, the losses on such assets, even in a fire sale, are minimal. And if you have the proper capital requirements to go with it, you're able to meet all those redemptions at any time. Then we have another category, which I think from a computer science and cryptography and engineering perspective, it's really clever. Things like MakerDAO with the DAI stablecoin, which are essentially stablecoins where, because they're trying to create the entire ecosystem on crypto rails, so without any bridge with the real world, they're collateralizing each dollar claim essentially with cryptocurrencies. Because cryptocurrencies are volatile, the inevitable consequence is that if you're trying to track the price of a dollar, you have to put in the reserve a lot more than a dollar at any point in time. So imagine $1.50 for each dollar of DAI that is issued. These stablecoins, I think we understand the economics pretty well. In most conditions are able to meet redemptions because they're capital intensive, right? So they have excess collateral, they have a buffer that can absorb those movements in value. They can also break the peg in extreme market conditions, but we haven't seen that yet. And last, there's the most dangerous category, which is the one that Terra Luna belonged to, which is the fully algorithmic, backed by their own equity token, so to speak. There's many different versions of this, and the coins are called many different things. But typically, these stable coins have a coin that's dollar denominated and it's trying to track the dollar. And then they have another coin, which is the one that's supposed to do all the magic, which is essentially upsiding the ecosystem. Think of it almost as equity in the broader ecosystem of the stablecoin, where if you're an equity holder and the ecosystem grows, you get some dividends, you get some form of returns, some appreciation. The bad side of that is that any change in expectations, and by the way, this could be driven by real change in fundamentals or just panic. Any change in expectations about the value of that secondary token, the equity token, rapidly makes it impossible for the stablecoin issuer or the algorithm behind it more to meet those redemptions. That's what we typically call a debt spiral, a situation where you need to sell more and more of these equity tokens to redeem at par on the other end. Now, it's funny because crypto kind of rediscovered our currency board collapse. That's historically something that we've seen in more traditional macro, and stablecoins have kind of inherited that with all of the problems. And so these are designs that are fundamentally unsound. I don't think we should call them stablecoins. Potentially there's something else, and they may have some use cases eventually. But I think, claiming that these will be able to track the value of a dollar is just folly. And I think we've seen the consequences of that in the recent meltdowns.
Yeah, I would add to that too, Christian, something that you pointed out in your academic work before is that the capital inefficiency of like DAI and the fact that it's over collateralized, it puts to question the long-term viability, even if it is a stable instrument. And the capital efficiency of the fiat back is likely to be much better unless regulators impose capital requirements that are overly burdensome, or they don't allow access. It's like a narrow bank charter or some sort of facility that would make the structure work. And so these are questions that are still open, and we don't know if we have a viable path to a stablecoin arrangement today until legislation is finalized in various jurisdictions.
Yeah, I think that's an extremely important point. And just to stress it even further, when you think about DAI, the viability of DAI, it's almost like, what is the price that people are willing to pay for greater forms of decentralization? There might be some applications where being able to not rely on a fiat bridge and traditional banking rails might be really important for the way the system is designed. And so for those, maybe people will be willing to pay a very high capital cost. When it comes to the fiat back, I think it really depends how the regulators will shape the capital requirements. If they shape them in a way where you have 4 to 5%, like today through the OCC for a narrow bank-like institution, that issuer will not be viable without other revenue sources. If instead they look at the quality of the asset, say treasuries only 3 months or less, and do apply Basel III, actually like any other financial institution to that type of reserve, I think they'll come down with a much lower capital requirement because the level of risk with high quality liquid assets is much lower.
All right, we are quickly closing on our time, but I want to press on one more issue, which is raised in the stablecoin paper that the Coinbase Institute put out, which was over 91% of stablecoins are fiat-backed stablecoins. So if we think about it in the context of the recent events where I think, Christian, you already said that the algorithmic, what's termed as algorithmic stablecoins, you would not even put into that category of stablecoins. How should we think about, as a public, the risk that stablecoins generally pose if over 91% of them are fiat-backed? Quick takes from all of you. We've only got a couple minutes left.
A lot less risk than people often cite. And the Basel Committee on Bank Supervision is walking through these issues, and they're looking at them carefully, and hopefully the capital charges they land are match the risk commensurate of the fiat-backed stablecoin.
I think the challenge is more about, what is the degree of transparency and auditability? I think we have stablecoins at scale today that claim to be fiat-backed, where there's little understanding about the quality of their backing. And again, if you have commercial paper, you have all sort of very risky assets, movements in the market will make that coin break the peg. And the question is, will people notice and will they run? And will you see another meltdown? On top of that, I think there's other important legal issues that need to be clarified. What is the claim that a consumer has in insolvency or bankruptcy of an issuer? Do they have precedence on other creditors of the stablecoin issuer? We don't have a framework that's bankruptcy remote today at the federal level and allows the strong guarantees that people have come to expect from things like FDIC insurance. I think there's a lot of missing pieces, and at that point, once those pieces are back in the picture and the regulators fill those gaps, hopefully we'll have really safe fiat-backed stablecoins.
I agree with both Scott and Christian. My thought is what Christian just said will take some time to sort out. And as a result, on the point that Scott raised about where Basel might land is, I doubt they'll land at someplace reasonable in the short term, it will probably be a fairly high capital charge, if not the highest capital charge under the existing framework. And then we will eventually, over time, get down to a more reasonable set of capital charges associated with this, especially if the regulators have their way, which is to try to push this more and more into the traditional banking system.
And is that what's going to move that capital charge requirement down? Is that if regulators are able to move it into the banking system, then they will think of it as less risky and require less in capital charge?
Absolutely. I think the issue Christian raised about, insurance, things like that will sort of lend itself to that kind of conversation. Look, at the end of the day, if it's fiat backed and there is good assets, this looks a lot like a debit card in many ways. And so when you start when the regulators are able to see things in that light, I think they'll start realizing that it's fairly traditional. It serves a lot of useful purposes, but it doesn't have the risks that people think about are associated with it now. But that will take time to work out for sure.
Okay, well, super grateful to all of you for spending this half hour with us and explaining this issue and putting it into context. Really appreciate it. And looking forward to another conversation sometime soon.
Absolutely. Thank you.
Thank you.